Financial management. Seven. Here's what I was thinking to do. Last time I covered financial markets. What I want to do is actually summarize it in a very short way for you to understand and to make it fairly simple and easy. So I'll try to repeat and review in hopefully 5 minutes financial markets. And the first one is called spot market. And again, for all of these, the definition, that's important to understand to make it easy. The definition is, it is a financial market where the transactions occurs on the spot. On the spot means immediately. That's it. So all of these are financial markets, and that's important key to make it easy. And every definition, without exception, begins a financial market. Okay? Where or which. So, next one, for example, futures market. Is a financial market where a contract is made today for a transaction in the future. Maybe 1 week in the future, maybe 1 month in the future, maybe 1 year in the future. So we agree today to and make the deal today to transact in the future. That's a futures market. Money market. Again, a financial market where money market instruments are traded. That's it. That's all there is to it. Capital market. A financial market where capital market instruments are traded. You can also say where long-term financial instruments are traded. That's it. Next one, primary market. Same thing. A financial market where securities are issued for the first time in order to raise funds. Secondary market. A financial market where already existing securities are traded between investors. You can also say among investors, okay? Private market. Is a financial market restricted only to qualified participants. That's it. Public market. Financial market open to the public. The meaning of public is anybody. Anybody with cash, anybody with money. And it's a little tricky, this one. It's a little tricky because they have what's called in the textbook physical asset market. It's simply a market where physical assets, the same as real assets, are traded. Okay, so this is market for real assets. Okay, and the other one will be called financial asset market. A market where financial instruments are traded. Remember that financial assets is exactly the same as financial instruments, is exactly the same as securities. So we can simply say a financial market where securities are traded is equally good. Okay, this covers the way I am looking at everything. Page 124, page 125, page 126. And now we move, I'll have to use actually 2 books, but that's okay. I'll be using 2 books for financial instruments, and I'll try over the next hour or so to do financial instruments. All financial instruments, we already said a few times, are divided into money market instruments and capital market instruments. In other words, into short-term and long-term, okay? The 2 primary long-term instruments are the stock and the bond. You studied these, you already had them before, maybe we can cover them later. There are many more short-term instruments. We call them also money market. They are more complicated, trickier, a long list of them with a lot of variations, and I'll cover them hopefully with the next 1 hour, maybe hour and a half or so. And we'll simply say money market instruments. Some of them, unfortunately, are confusing, and part of my job is to clarify. Number 1, Treasury Bill. Treasury Bill. Of course, all of these, without exception, are money market instruments, so the definition always begins in the same way. It's a short-term financial instrument, and then we continue. Issued by the government or issued by the Treasury, and now we finish, in this particular sense, at a discount, at a discount. At a discount, it's called a discount instrument. It brings and yields no interest. There is no coupon. And the only way that the buyer, we call him investor, gets return is through the discount. It is always sold at a discount, and the discount from the principal represents the return to the investor. Okay? So, that's the one characteristic, at a discount. The second characteristic, which is written in every single textbook in the world so far, is that it is risk-free. This is totally very, go ahead and do your thing, okay? Outside, not here. The second characteristic, which is risk-free, totally and completely wrong. Totally and completely wrong. First of all, treasuries and governments go bankrupt all the time. Bankrupt governments are extremely common. In our other class, okay, in our other class, we had the discussion of government of Iceland going bankrupt recently. Another government going bankrupt is Ireland. Now we know that Greece is technically bankrupt, meaning they are, insolvent, technically insolvent. They will never be able to pay their debts back. And there, Treasury securities are certainly not risk-free. Now, let me clarify and explain. When the government issues its Treasury securities in its own currency and is able to actually pay back with printed money, then the correct statement to say is that these securities are default-free. Default-free. Default-free doesn't mean risk-free. Default-free means it is free from the risk of default, but it has other risks. It still has currency risk with it, okay? As any financial instrument, it still has interest rate risk. It still has purchasing power risk. We call it also inflation risk. So, the point is, it has a whole bunch of risks anyway, but at least it doesn't have the risk of default, because no matter what happens, no matter how government deep trouble is, it will just print more money and pay back its treasury, okay? Well, right now this is exactly the situation in the United States today. The United States government cannot effectively and technically cover all of its debts. It cannot even service them, so at this point in time, all they're doing is, we call it monetize. Monetize means the central bank prints the money, buys the treasury instruments, and gives the freshly printed money to the government. In this particular way, the correct way of thinking is that the government is printing and spending. So when governments print and spend the money, what actually happens is the central bank prints the money, gives it to the government, and the government issues or prints a treasury bill or note or bond and gives it to the central bank. So there's an exchange of money for treasury where the money is freshly printed by the central bank. This process of purchasing by the central bank of government instruments in order to finance the government is called debt monetization, and is the reason why the security is always default free. They don't have to default because they can always print more. But if they print more, now I get currency, interest rate risk, and all sorts of other risks. Okay, so that's Treasury Bill. Let me see. Okay, what other characteristics it has this? The market is deep. A deep market is practically the same as liquid. You can buy huge quantity without driving up the price. And alternatively, you can quickly sell a huge quantity without driving the price down. So, the market is very convenient for huge quantities, easily to move in and out. And this is another reason why the Chinese government prefers to invest most of its assets, financial assets, into treasuries. It's called the depth of the market. They can buy in as much as they want, 10 billion, 20 billion, 30 billion in a day, no big deal. Or they can sell 5, 10, 20 billion in a day, no big deal, okay? That's called deep market. The market is deep free, and therefore, now deep is not the characteristic of the treasury bills, the characteristic of the treasury bill market. Okay? You can just buy and sell as many as you want. Okay. And therefore, let's kind of like write it like this. The market is liquid. The market is very liquid. Today, so far, because the treasury bill is considered the safest instrument, it is also happens to be the most liquid market in the world. Okay. Let's see. There are two ways I am following. Let's do this thing here. Your standard book that you have used by Michigan. Okay, this is just a new cover in a new edition, Michigan's book. And I'm going through chapter 11, money markets. And within money markets, I'm going only one section called money market instrument. Section 4 is money market instrument. I have noted about, let me see, 6 or 7 or 8 instruments. I have 7 instruments here, and that's what I'm going to be covering this hour and maybe next hour. So, let's move on. The market runs in two ways. The first way is called competitive bidding. Competitive bidding. So now I'm beginning to explain how the Treasury Bill market works. And it works either with competitive bidding, where investors simply submit their bid. They say, we want to buy so many for that yield. Okay? And everybody submits their bid. So they say, oh, we want to buy 10 billion at 2%. The other one says, we want to buy 1 billion at 2.25. We want to buy $500 million at 220. So everybody submits their bid, everybody submits their quantity, the bids are sorted and ordered, and the government takes the best bids. The government says, we want to issue 35 billion. Okay? They sort the bids, they take the best bids, when they reach 35, they cut off the point and say, these are the bids, you take the treasuries, okay? Those who bid the price, they take it. Those who bid below, they don't take it. It's that simple. It's called competitive bidding. The alternative is called non-competitive bidding. Non-competitive bidding is simpler and easier. It simply means that the buyer says, I want $2 billion of Treasury bills, and I will pay the market price. So, those who bid competitively will determine the market price, and if the market price is 2.18, the non-competitive bidders will all get their quantity at 2.18 at the market price. So they just say, we don't care exactly if it's going to be 218 or 222 or 224 or maybe 215. Whatever it turns out to be, we're going to buy 2 billion. We got 2 billion to invest. We want to invest it. The exact number is not particular. We'll take it anyway. 215, 220, it's all the same to us, okay? So these are the non-competitive bidders. Competitive bidders say, we're going to invest 2 billion, but if we get at least 221, if you're offering 220, 219, we're not getting anything. And we don't want to get anything, okay? So those who want to get whatever they want to get, they just do non-competitive bid, and they're guaranteed to get as much as they want at the market price. Those who do competitive bidding, they are guaranteed to get a better price than what they offer. Always, okay? And investors choose as they like to be competitive or non-competitive, okay? And that's all there is to this particular piece. Another important characteristic is called a book entry. Book entry, let's see how they call it. Book entry security. Let me do the following little trick. Right here, the opposite. And the opposite is called bearer security. Bearer security is a financial instrument which is paid or repaid to the bearer. For example, $1,000 bearer bond will be paid to whoever bears the bond. If the bond is in my pocket, I take it out, I go to the bank or to the government. Actually, the bank will be acting on behalf of the government. And I say, okay, I have the bond, I'm the bond holder, and the bond matures today, and I want my 1,000 back. And they'll just pay it to you. Now, if you happen to steal it from me, you can walk in the bank and get the 1,000 from that bond, okay? Or it may happen that I just want to sell it to you and say, hey, I want to sell it to you for $9.95, and you can make $5 in 3 days, okay? So you take it from me from $9.95, and then you walk in the bank when it matures. Well, that's called a bearer security. Bearer security is paid to the bearer whenever it matures. Bearer is the person who owns and possesses, meaning who bears the security with him on maturity. Bearer securities are risky in the sense that they can be just stolen. They could be simply stolen from you. That's the primary risk of a bearer security. But bearer security is really good. You may have a bearer security with a face value of $10,000. Okay? You can bring in a nice tiny little super skinny folder of, let's say, only 100 sheets. Okay? 100 sheets will be that much. And with it, you can carry $1 million. Okay? With a nice little stack of paper like this, you can carry $10 million, okay? It's very good for drug dealing, when you have illegal payments, okay? So it is anonymous, doesn't have your name, they don't know who got it and how it passes from person to person. So it's good for illegal and underground transactions too, okay? That's the bearer security. The alternative security is called book entry security. In a book entry security, it is a financial instrument, but it does not have a physical document. It is only recorded on the computer. Back in the old days, only on the books, okay? And the books have your name, have every single name of every single investor, and whenever there is a buy or a sale, the name changes for that particular security in the actually Treasury, or the bank, the financial institution which handles the transaction for the Treasury, okay? So it's only in book entry form. In other words, everything is 100% computerized, okay? Let me see where I was and how I lost my page here. Okay, book entry security. Okay, that's very nice. I have here on page 303, I have marked at the very bottom how it says, Treasury bills are very close to being risk-free. Totally wrong, okay? They're close to being default-free, not risk-free, okay? Is there a question? Question? All right, so you have to understand, a lot of times the textbook make a mistake. Sometimes the mistake is innocent. They weren't careful, okay? They weren't precise. Sometimes the mistake is usually intentional. It wants to mislead you. It wants you to get the wrong information. It wants you to understand things incorrectly, or better yet, they want you not to understand the way things actually are, okay? In other words, keep them fooled. If they're fools, we can keep them fooled, and we can separate them from their money, okay? So sometimes the intention might be actually evil. All right, so certainly it is not risk-free, but it's close to default-free. It's got a whole bunch of other risks. Let me see what else I have. That's good enough. Number 2. Fed funds. All right, let me try to avoid confusion. In case you have textbooks, maybe let's try this little Sony camera and try, Zach, to zoom in real well and real nice. You can open on page 126. You have a nice, short, sweet little table over here. Table 5.1 says, summary of major market instruments, market participants, and security characteristics. And now you can look on instrument number 1, U.S. Treasury Bills. This is the same as Treasury Bill as I wrote it. And you can say, market, money market, as I explained. Number 2, sold by the U.S. Treasury. So, for every security, you need to know the issuer. You need to know the main investors, you need to know the maturity, and you need to know the risk, or the risk in return. And then it tells you major participants. Riskiness. Oh, they have it much nicer and better in this textbook. It says default free, close to riskless. And then it says original maturity, 91 days to 1 year. Interest rate on a particular date. In 2008, interest rate was 2023. So what they're doing here is giving a nice, sweet, short, easy summary for you to remember and understand. And I'm doing just a little bit more than that. Okay, let's get back to number 2. Fed funds. Fed funds is standing short for federal funds. So they usually call it federal funds. In the textbook, I am back on page 304. Fed funds is important to understand is actually a deposit at the central bank. That's it. A deposit at the central bank. It is an asset for the depositor. It is a liability for the central bank. As an asset, a deposit at the central bank, the only risk it bears is the risk of the central bank. So this is actually like risk-free because it has no risk except the currency risk. It's got only currency risk with it carrying. Fed funds is a deposit, let's clarify, of a commercial bank at the central bank. And now I'm clarifying, usually for the purpose of satisfying minimum reserve requirements. Commercial banks and other, we call them depository institutions, are required by law and regulation to maintain deposits, reserves, either in the form of cash or as deposits at the central bank. Well, that deposit at the central bank is simply called Fed funds, okay? Basically, it simply means funds at the Fed, okay? Funds at the Fed. Let's see what it is. Okay, if a commercial bank has more reserves than it needs, so at any given day they have a minimum required reserves. Let's write this down. Minimum required reserves. Minimum required reserves. Now, let me explain the next concept is total reserves. Total reserves. So, total reserves is simply all the reserves which a financial institution has. Whatever their reserves are, we call them total reserves. Minimum required reserves are the reserves that they must as required by law. The reserves they must have, which they must maintain because the law requires them to maintain. And now comes the next little piece. If you have, let's say, minimum required of 9 billion, but you actually have 10, the difference between what you have is called excess reserves. Excess reserves. They simply have excess reserve. These are reserves which they actually have, but they don't need because they're not required by law to have. And what they will do is simply lend them to somebody else. Lend them to somebody who needs them. So the key to understanding reserves is that reserves do not earn interest and therefore bring you a return of 0. Therefore, if you have excess reserves and these reserves are deposited at the central bank and they still earn you 0, if you lend them to the other bank will pay you interest. And Fed funds, interest rate on Fed funds is called Fed funds rate. Fed funds rate. And Fed funds rate is simply the interest rate that a borrower pays to borrow a deposit at the central bank. In other words, to borrow Fed funds. So, if you have funds of the Fed, you want to lend them so you can make some money. And you usually lend them for a day, or usually for a week, for a very, very short period of time. Very common is actually an overnight loan. Okay, overnight. Let's write this out separately in red. Overnight. Let's call it overnight loan. Is simply a loan which is made, or let's say, which matures in one day. A different way of saying which matures on the next day. Okay? Basically, I'm lending you the money today, and you're going to pay it back to me tomorrow. That's an overnight loan, okay? That's it. So, usually, Fed funds loans are usually overnight, okay? Let me see what else we have on Fed funds. Minimum required, okay, term, okay, the effective rate, and that's it. Number 3. Number 3, repo. And first we clarify that repo is standing short for repurchase agreement. And repurchase agreement has a definition and interpretation. The correct legal definition is the sale of securities with an immediate agreement to buy them back on a future date at a specified price. So, I'll sell you my book today for $20 US, okay? And I'll buy it back next month for 21. Would you like to do that? Yeah, you will make $1, okay? You will make $1 profit. Oh, it's a lending operation. It is not a profit. It's $1 return, okay? Now, are you safe with your lending? The answer is, yeah. If the textbook is worth 20 or 25 or 30, you are safe, okay? If the textbook is worth 5, you're not safe, okay? So, The legal definition is I'm selling it to you. After 1 month, I agree to buy it back at a little higher price. And that little higher price will give me the return to you. When I sell you the security, you are giving me money. And after 1 month, I'll give you the money back. So the economic meaning of a repo is a secured loan. Let's write it out. Secured again, repeating, technically and legally, it is a sale and will be repurchased later. Economically and financially, the meaning is simply that of a loan, a secured loan, where the difference between the sale price and the purchase price is the return on the loan. Okay, secured loan. And that's what a repo is. Repo is considered very, very, very low risk. Why? If he doesn't have the money and can't pay you back, you just keep the security. That's it. You just keep the government bond. So usually a repo will work with a very low risk security itself. It will usually work with a Treasury bill or very highly rated low risk other instruments. Okay? So that's what a repo is. Let's see what else. Okay. They actually call it, when we say secured loan, let me write another little word for you, which they have in the textbook. They call it, and I'm going to write it with red over here, collateralized. Collateralized loan. And a collateralized loan is simply loan secured with a collateral. That's it. So basically, secured loan and collateralized loan is exactly the same. Okay? Let me try to finish now and see what else. Oh, it turns out that it is used very, very, very commonly by the central bank, where the central bank likes and wants to participate. We call it intervene on the repo market to conduct monetary policy. Monetary policy means control of money supply, control of the quantity of money in circulation. So, the central bank actively participates in the repo market so that they can inject or withdraw liquidity from the financial system and use the repo market to conduct monetary policy. Let me see what else. Short-term, low risk. I wrote that. Yes, I wrote that. And that completes number 3. We finish for now and continue with 47.